On my way to the grocery store, I mentally prepare myself for what's to come, the dreaded sticker shock. And it's not just me. It seems that people all over the world are feeling the effects of inflation. In the US, it's diapers that are hitting my wallet the hardest. In Ghana, it's food. And in India, it's home prices. But what's causing all of this inflation? And is there something we can do about it? Many people point to the COVID-19 pandemic as the main cause of inflation, and there's certainly some truth to that. The pandemic has disrupted supply chains and caused shortages of certain goods, which has driven up prices. But this explanation only tells part of the story. Inflation is a complex phenomenon that is influenced by a wide range of factors, and COVID is just one of them. One popular explanation for inflation that you might hear on cable news is that there is too much money chasing too few goods. The idea here is that governments have been pumping money into the economy through stimulus checks and other measures, which has led to an increase in demand for goods and services. But because supply chains have been disrupted, there aren't enough goods to meet this demand, so prices go up. Economists like Larry Summers have been sounding the alarm bell on this kind of inflation from the beginning. Summers has argued that the pandemic relief checks and other government interventions are the least responsible macroeconomic policies we've had in the last 40 years. He believes that these policies will lead to sustained inflation in the years to come. But before we can determine whether Summers is right, we need to take a closer look at how inflation is measured. Once a month, the U.S. Bureau of Labor Statistics puts together what it calls a market basket. The data is specific to the U.S., but you can find similar numbers around the world. The BLS looks at the prices for different goods and services like housing, electricity, apparel, prescription drugs, bakery products, and dairy. They look at the price we're paying this month and then compare it to the price for that same good or service last month or last year. Then they calculate a single percentage that captures all of that change, and that's the Consumer Price Index, or CPI. Consumer Price Index has been rising steadily for the past couple of years, which is when those stimulus checks started to come out. Take a closer look at some of the specific goods and services that make up the CPI. Some things are way more expensive than this time last year, like fuel, airline fares, baked goods, and dairy products. But there is some stuff that's held fairly steady. In a normal, healthy economy, the Fed expects inflation to be about 2% a year. And for stuff like clothing, prescription drugs, and education, prices are only slightly above that 2% mark. For used cars and trucks, gasoline, and communication, your phone plan, internet, and streaming, for instance, prices are actually lower than this time last year. It just seems a bit more complicated than simply people have too much money. If that were the only problem, wouldn't everything be more expensive? So why are some goods experiencing much higher levels of inflation than others? Well, one way to understand this is to think about the costs of a business. There are the wages that a company pays its workers, their investments in capital and machinery, and the cost of the materials they use to produce their goods. All of this adds up to the cost of production. And then there's the price at which the company sells its goods, which is higher than the cost of production. The difference between the cost of production and the selling price is the company's profit. Now, when the cost of production goes up, the selling price needs to increase too if the company wants to maintain its profit margin. And this is what's happening in many industries right now. The pandemic has caused disruptions in supply chains, labor shortages, and rising raw materials costs. All of these factors increase the cost of production, which in turn drives up the price of goods. For example, the price of lumber has skyrocketed in the US. The pandemic led to a surge in demand for housing, which in turn drove up the price of lumber. At the same time, lumber mills had to shut down or reduce production because of COVID safety protocols. This combination of increased demand and reduced supply caused the price of lumber to increase by more than 300% in some cases. And because lumber is a key component of new home construction, this increase rippled through the housing market, causing the price of new homes to rise as well. So while it's true that the government's stimulus measures have contributed to inflation, it's not the only factor. Supply chain disruptions, labor shortages, and rising raw materials costs are all contributing to the inflationary environment. And because these factors are largely outside of the government's control, there's not an easy solution to the problem. With that being said, there are steps that can be taken to mitigate the effects of inflation. For example, the Federal Reserve can raise interest rates to slow down economic growth and reduce demand for goods and services. This would help bring inflation under control, but it could also lead to a slowdown in economic activity and job losses. Another option is to invest in infrastructure and education to boost productivity and reduce costs in the long run. This would require significant investment of resources, but it could pay off in the form of higher economic growth and lower inflation over time. In conclusion, inflation is a complex phenomenon that is influenced by a wide range of factors.